This new bill is very exciting. We want to talk about some different areas. 179 deduction it's increasing up to 2.5 million. So that's a big jump from 1 million to 2.5 million. I think the biggest concern I've heard is, what am I going to do now with a lot of our clients are tech related and they do R&D.
Tim Fargo. He's a client CFO here at Rose, as well as our tax partner and CPA over at Rose. He's been here at Rose since 2006 and became partner in 2007. Tim Fargo has over 30 years of experience in accounting and business management, including 10 years of being a CFO of in the nonprofit sector. Tim has helped our clients here at Rose navigate complex financial landscapes, tax planning, and providing that financial clarity our business owners need to achieve more.
So, Tim, let's start things off with the business tax reform. What are the biggest changes that the business owners should be thinking about today?
So let's talk about a few more areas that for businesses. We did talk about some 179 deduction, but there's also manufacturing deductions too. You get 100% expensing on qualified production through 2032. That's if you're already in the production area. That started this year. That was not anything that was in the past. We do have an advanced manufacturing credit, so it increased to 35%. It was 25%. So that also is an additional, if you're in manufacturing, this is great for planning because now you have additional deduction and you have the credit is increasing. For 179, we talked about that earlier, but 179 deduction that's where you really want to get your planning with the bonus depreciation 179. It's increasing up to 2.5 million. So that's a big jump from 1 million to 2.5 million. It was being indexed. But now it's going to be phased out at 4 million. So you want to plan your purchases, and it's any property placed this year. So now when we're looking at equipment purchases, what have you already purchased this year and what are we planning for 179? And then we want to start to look at that equipment and see where we want to put it. So it's important to really get your tax advisor involved when you're planning these purchases. Next area is a couple things that are going away. So the tech neutral credits are no longer, they're fully eliminated as of this, effective immediately, effective the bill. So that had been an area where people were taking those credits. Those are gone. Pass-through entity tax. So the new law allows for the pass-through entity tax. It's maintained. There are 30 plus states that do allow for the pass-through entity tax. This is important for a business owner. We'll talk a little bit further when we talk about individual, but if you're not taking advantage of the pass-through entity tax and you pay state taxes on your business of $40,000 or more, then you really need to make sure you have a good planning session to understand why you're not taking advantage of those pass-through entity taxes if your states allow it. Because the pass-through entity tax, just as a definition, it allows the company to pay state income taxes on behalf of the owners and then pass that state income tax down to the owner as a state tax payment. But then for federal tax purposes, you can take that full state tax deduction as a pass-through entity tax, PTET. And so that's important if you're paying a fair amount of state income taxes and you're allowed pass-through entity tax. A couple other areas we want to talk through is there is some new opportunity zone designations allowed. They've expanded those, and then it's really just expanding them and then extending them. They were going away through the previous law, so we wanted to make sure that those zones maintain. So if you are looking at moving or buying property, it's important to look at to see if that property is in an opportunity zone, and then you get the benefits of that zone. One area that for small and growing businesses that did increase, they changed the rule that said after 25 million, you had to automatically switch to accrual basis, and they moved it up, but it was at 25 million, and now they increased it up to 80 million. So if you were about to hit 25 million this year and 25, you don't have to go to cash basis. And the benefit of cash basis is you can do cash basis planning if you're depending on how you're structured, and if you can cash basis often does provide you benefits based on paying taxes on the cash in and the cash out. One more area that is important for businesses and this is a strong area though, which I think a number of businesses who are hiring will be able to take advantage of. This is a $5,000 actual credit per qualified individual. So it's per qualified hire. So there are very specific limits, meaning it has to be a targeted veteran. They have to be long-term unemployed. There's certain structured areas on who you can hire, but if your hires qualify, then you can apply for and receive this credit. some of the enhancements through the apprenticeship program and retention requirements within this credit would apply. So it's important if you are hiring new individuals, just confirm with your HR team that you do qualify, or if you do qualify for this credit, make sure it gets applied to. So a few areas I just wanted to point out that did go into effect this year, so just things you need to look at right now. Bonus depreciation, fully 100% restored. Section 179, the expensing is both expanded on what you can do, but also it's up to $2.5 million. Opportunity zones have expanded. Cash accounting, it's elevated up to $80 million. A couple things that I didn't go through, but if you're a sound recording or a music studio, they do allow they have a very specific area on just sound recording and expensing. It's usually it looks like it's very specific just to that area. So if you are interested in that, we can talk a little bit further, or we'll put something in the community about it. Expanded floor plan financing. If you're buying a camper or a trailer, there's additional financing on the deduction there. And then we'll talk a little bit right now about the FDIL and GILTI deductions and how they're improved. And of course, the bonus depreciation. So those are all things that go into play right now. So let's talk a little bit about international sector. We're going to talk about both the territorial system, some of the changes for GILTI and BEAT, and then some of the other targeted sectors. So internationally, the international system, so it's moved from a worldwide system to a territorial system. What they're moving more towards is, and this is really in the GILT and then in the FDIL changes. And what we want to do is talk about the territorial system. We're going to talk a little bit right now about the global intangible assets and the change of the taxable interest there and the change of the name, and then some of the foreign income, and then we're going to talk about some of the BEAT, the transfer there. So the shift to the territorial system, so it's shifting from the worldwide system to exempt, and the subsidiary system. It's not much of a change, but it's more focusing some of the dividends back on the repatriation and the foreign income. So it's taking and taxing globally, and then it's qualifying certain subsidiaries to be exempt. And then the dividend repatriation, it's really shifting from what was brought into the US to an exemption on certain qualified dividends. It encourages a lower rate of reinvestment back in the US. So now it used to cash held offshore used to have a different rate. Now it's encouraging the repatriation rate and the reinvestment in the US. And then it's replacing the GITL with just a new terminology. And there are a fair amount of international pieces in here. So we're just talking high level, but we might do another session or just individually put the community things on the international side. So the FDII, which is the Foreign Derived Intangible Income Act, and then Global Intangible Low Income Tax. This area has been adjusted a little bit first. The GITL has been changed, and the name is now Net CFC Tested Income, NCTI. They changed the name, and then they permanently decreased deduction down to 40%. And it allows for foreign tax credits, but it's for the CFCs, and it's based on income versus pulling it. So the Foreign Derived Income Act it's renaming that to FDDEI, and then it's excluding income based on the intangible assets section and pulling that back, and it allows for depreciation deductions as well. So this is it's just changing some of the rules. So if you do have foreign subsidiaries and/or you're coming into the U.S. and you're moving funds back and forth, it's better to work with your tax advisor to make sure you have the best tax strategy and then pulling in the right amounts, because it is expected to reduce some of your income, especially if you're bringing funds back into the U.S. So the GTIL it's just changing the rule on the CFCs, providing foreign income tax credit, and then it's effective after 2025. So that's not effective. That specific one is not effective until the end of 25. But the renaming is effective immediately. The BEAT's the base erosion and anti-abuse tax. It raises the threshold on some of the FTC and the threshold for qualified payments back and forth and one-time foreign earnings. So it does allow for the transition tax of moving funds back into the U.S. and then also assets, and then moving assets out. So it does reduce the rate down, makes it very competitive in the world for pulling cash into the U.S. And this is mainly for corporations who are holding cash and assets outside the U.S.
What's the biggest concern that you're seeing our clients face right now?
what am I going to do now with a lot of our clients are tech related and they do R&D. How do I need to shift what I'm doing with this 100% R&D? Now I could have a huge loss, or I'm reducing my taxable income down dramatically. What do I need to do for planning? Remember, this is only on the federal level. The state hasn't changed. So that means that your R&D is still following the state amortization rules. So they need to plan out what's happening within the state and then look at your federal side. But that's the one I've heard a lot of questions on. How do I now go back and plan for the big R&D credit?